Welcome to the Deep Dive. Today we are tearing into the fiscal fourth quarter 2025 earnings for Valvoline, ticker VVV, which dropped just before the market opened on November 19th.
And this is a deep dive you really need because this call was a tale of two companies, really.
A split personality.
Exactly. Our mission today is to unpack these two conflicting stories. On one hand, you have this incredible operational machine delivering, market-leading growth.
And on the other?
On the other, you have a major financial reset. It's all driven by the huge amount of debt they just took on for the Breeze AutoCare acquisition. It's growth versus leverage, plain and simple.
Absolutely. So the question for you is, did the growth engine finally get bogged down by the financial headache of this deal? Let's just jump right into the numbers.
The headlines definitely lean towards disappointment. I mean, they hit the financials pretty hard. Adjusted EPS came in at 45 cents.
And Wall Street was looking for what, 48 cents?
Around 48, yeah. So that's a miss of about 6.25%. Not huge, but a miss is a miss. Revenue, or net sales, was $454 million.
Also just shy of the range.
Just barely missed that $455 to $456 million range.
And you could really see the weight of the deal on the bottom line, the GAAP net income. It fell off a cliff.
Huge drop. It came in around, 25 to 26 million for the quarter?
Compared to 92 million last year. Now look, that wasn't a total surprise, but it still stings. It's all driven by higher interest costs and a bunch of one-time items from the M&A.
But then you flip the page to the operational report, and it looks like a completely different company, a growth stock in a booming market.
Right. System-wide, same-store sales, SSS, were rock solid.
Plus 6% for the quarter, and that performance seals their 19th consecutive year of SSS growth. The full year came in at plus 6.1%.
Think about that. 19 years.
It's an incredible track record.
Right? That is an elite club. I mean, that kind of consistency, no matter what the economy's doing, it just speaks volumes about their business model.
And they're not slowing the expansion either. They added 56 net new stores just in Q4.
Bringing the total to, what, almost 2,200?
2,180. That's up 8% year over year. And even the adjusted EBITDA, it showed that resilience, hit $130 million, up 5%.
And if you strip out some of the noise from refranchising, that growth is actually closer to 9%. So the core stores are humming.
They really are.
So you have fantastic underlying momentum, but the market saw the EPS miss, and maybe more importantly, the debt challenge is ahead. The stock closed down about 2.5%.
On heavy volume, 2 to 3 times normal. And that volume spike, that's the key data point.
Okay, why?
It tells you institutions were moving, they were aggressively pricing in the complexity of the deal, the new debt. The financial miss and the integration risk in the short term just completely outweighed the operational wins.
It was a repricing event.
A necessary one in the market's view.
Okay, so let's dig into that operational engine, because that's the heart of the long-term thesis here. Management was really clear about demand. They called auto maintenance non-discretionary.
This is their moat. They were adamant, saying they are not seeing customers trade down or defer service.
Which is a huge statement in this kind of macro environment.
A very powerful statement. They said they're seeing growth across all income levels, which reinforces the idea that if your car needs an oil change, you get an oil change, period.
And when you look at how they're getting that SSS growth, it's a healthy mix.
It is. About a third of it was just transaction growth, more cars coming through the bays. The other 2/3 was from a higher ticket.
And that ticket growth isn't just them hiking prices, right?
No, it's very deliberate. It's some net pricing for sure, but a lot of it is encouraging customers to move to premium synthetic oils and a big push on what they call NOCR.
Non-oil change repair.
Exactly.
Yeah.
Tire rotations, fluid flushes, battery swaps. It's all about upselling higher margin services and shifting that revenue mix.
And they also talked about getting more efficient internally. They rolled out some new tech this year.
Yeah, they mentioned Workday for labor forecasting and a new workflow system they call SuperPro.
Are these just buzzwords, or are they actually moving the needle?
They claim it's driving real labor efficiency. The goal is simple, right? Maximize the number of cars you can service, minimize wasted time. It's how they're fighting inflation and trying to protect margins.
But despite all that work, the gross margin rate was flat. It seems like they absorbed a pretty brutal hit from product costs.
120 basis point drag. It was a perfect storm, really.
So what happened?
Well, supply chain inflation was part of it, but the bigger issue was the lag in base oil prices. They explained that even though crude oil prices dropped, their main ingredient, base oil, takes 3 or 4 months to follow.
Wait, why the lag? Is that a contract thing?
It's mostly inventory. They hold a huge amount of base oil in their system, like 90 to 120 days worth. So the oil they were using in Q4 was actually bought months ago, back when crude was much higher.
Ah, so they're just running that expensive inventory through the system now.
Exactly. It's a painful timing difference that's directly hitting Q4 margins.
And then there's this other weird thing with used oil pricing. That used to be a good thing for them.
It used to be a reliable offset, yeah. They could sell the used oil to re-refiners for a nice credit. Now, used oil prices have totally collapsed.
So they're getting little to nothing for it.
Little to nothing. In some markets, they're actually starting to get charged for disposal, so it's flipped from a revenue tailwind to a cost drag. It's a fundamental change to the economics.
And that all flows through. Okay, let's talk about the big one, the thing that's hanging over the stock right now. The Breeze AutoCare acquisition.
This is the inflection point. The deal's on track, set to close December 1st after they got FTC clearance.
Which required them to sell some stores.
They had to divest 45 stores. So in the end, Valvoline is getting 162 net new locations for about $593 million.
And the financing here is what made investors really nervous. They're using a new $740 million term loan B.
Right. And for the listener, a term loan B is, typically high-yield debt sold to institutions. It gives management more flexibility because it has fewer rules, fewer covenants.
But it carries a higher interest rate and a higher risk profile.
And it immediately lifts their leverage ratio from 3.4 times EBITDA all the way up to a pretty hefty 4.2 times.
4.2 is a big number for a retailer. Management said they'd get that back down, but it's going to take a while.
18 to 24 months is what they're projecting, through a mix of growing EBITDA and just paying down debt.
But the analysts really pushed them on the price they paid.
They did, because Valvoline acquired the Breeze stores for nearly $4 million a pop, but then they had to turn around and sell those 45 divested stores for less than $1 million each.
That is a massive write-down, just to get the deal done. I mean, can they really make up that kind of short-term hit, plus integrate 162 lower-margin stores, all while paying down a huge loan? 2 years feels ambitious.
That is the entire investment debate right now. Management framed it as the cost of doing business, the cost of getting that scale.
Strategic necessity.
Right. They are betting that they can take their high-efficiency playbook, apply it to these underperforming stores, and generate so much more profit that it quickly erases the pain of those asset sales. It's a huge bet on their own execution.
Okay, let's look at the guidance for fiscal 26, because this is where that debt burden just crashes the party.
They're guiding for aggressive growth. 330 to 360 new stores, revenue targets of $2 to $2.1 billion.
Strong top line.
Very strong. And yet, adjusted EPS guidance is 160 to 170.
Which is way below where the street was. I think consensus was around $1.88.
It's a significant reset, and we need to be clear about why. The single biggest reason is the new debt.
The interest payments.
The interest expense from that term loan B is going to hit fiscal 26 EPS for about 20 cents a share. That is a huge direct headwind coming just from the financing structure.
And on top of that, margins are getting squeezed.
They expect about 100 basis points of pressure in the near term. That's all from bringing on the lower margin Breeze stores and just the general costs of integration. It's the price of scale.
Okay, zooming out. How should an investor think about all this? The stock has been a laggard for a while now.
It's materially underperformed the S&P and other retailers for the last year. It's been trading near 52-week lows. So the market was already baking in a lot of this risk.
So the 2.5% drop on the day, that wasn't a panic. It was more of a confirmation.
I think so. Investors saw it as, incrementally negative, but not thesis breaking. It was the painful reset everyone expected, confirming the cost of the deal, but it didn't shatter the long-term story.
The core conflict remains. You have management pointing to this resilient, non-discretionary demand and their incredible 19-year track record.
While the market is just laser-focused on the capital intensity, the interest payments, and the execution risk that comes with a 4.2 times leverage ratio.
And the next big catalyst is just around the corner. They have an investor update scheduled for December 11th.
That is the moment of truth. They have to come out with a detailed, credible, step-by-step plan for how they're going to get that balance sheet back in order.
Okay, that brings us to our final segment. This is not financial advice. This is where we distill all this into a speculative trade idea purely for educational purposes.
The thesis here is pretty simple. You're betting on Valvoline's execution playbook over the market's current fear. We think the market has priced in the absolute maximum near-term pain.
The debt drag, the EPS hit, the integration risk, it's all in the price.
It's all in the price. The stock is oversold near its lows, but the core business is still a best-in-class compounder.
And we saw something interesting in the options market. The expected move was plus or minus about 6.4%, but the stock only actually moved 2.5%.
That gap tells you that there is still a ton of panic and uncertainty priced into those options.
So the trade is?
The trade pitch is a long-term bullish one. Sell out of the money puts on the stock with expiration dates way out in late 2026 or even early 2027.
So the idea is you're timing the deleveraging.
Exactly. You collect that high premium today, betting that by late 2026, VVV will have delivered on their 18 to 24-month plan. They'll have leverage back under 4 times. They'll have normalized the Breeze margins.
And as that financial noise fades, the market should start to care about the growth story again, which would push the stock up, making the strike price where you sold the put very safe.
It's a bet that the market's short-term fear will evaporate as that 19-year growth story reasserts itself. You're getting paid to wait for the story to get clean again.
To recap then, VVV delivered on operations. The growth is real, the foundation is solid. But the market is, for now, completely fixated on the financial cost of this acquisition.
Which leaves you with the ultimate question. Given the pressure of that 4.2 times leverage and the 18-month clock to fix it, can management keep their amazing 19-year SSS streak alive while executing this massive integration?
Or will the need to pay down debt force them to pull back on the very investments that drive that growth?
That is the story to watch.
And we'll get our next big clue on December 11th. Thanks for tuning into this deep dive. We are not investment advisors, and this content is for informational purposes only.